Yes, Anna. It's great to have all these people that are obviously very interested in uh, learning new trading styles. One of the things that I think was just kind of time appropriate for me was how to buy the dip. Since we've gotten a dip, it's not a major correction yet, but we've started to see some weakness in the markets. And for those looking for a way to buy the dip, especially using the um, leverage and defined risk of options, I wanted to get that this set up for today. Um, so first things first, if you have questions, feel free to throw them into either the chat box or the Q&A box, and I will do my best to answer as we go through. Um, as I'm sure you've all seen, I got to do my disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through this while I take a quick sip of coffee, and then we will get into the good stuff. All right. So with that in mind, I like throwing my picture up here. For those of you that are not familiar with me, I've done a few of these presentations with Investor Expos. You may have seen me in some of my other presentations with other places, including at our home site at optionhotline.com. I started my career in the option pits of the CBOE back in 2005. So really, I guess, earned my stripes by trading through the subprime crisis as an options market maker. So it was a crazy time. Stocks went absolutely nuts. For those of you that follow the VIX, it exploded. And of course, it was a time where options really became a major focus for a lot of investors, realizing that benefit of using them for hedging strategies to find risk. And also those that got burned by putting too much capital into individual options trades, particularly when the market hit lows. If people were buying puts at that point, just naked, it was a very painful time for them. As the market recovered, markets tended to tighten up a lot. We switched to a lot more electronic trading. What that did is it made markets, instead of being a nickel, a dime, 15 cents wide, not necessarily great for the retail trader. A lot of markets now are about a penny or 2 cents wide. Really good for the retail investor. Not so good for the market maker because the margin goes away. The market maker's job is to effectively be there to buy the bid and sell the ask. When there's a lot of volume and markets are wide, that's great. When there's a lot of volume and markets are tight, it's okay. When there's low volume and markets are tight, it's not so great. Coming out of the subprime crisis, the market got really tight and volume started to come down a little bit as well because it wasn't quite as exciting of a time with the VIX dropping back down towards more normal levels. It made me realize that I needed to get a better edge on options, really understand more of the second order and third order derivatives, the skew and everything else like that. Got my MBA from the University of Chicago with honors, decided to go work for a hedge fund. Now, the idea here was that by going to a hedge fund, and in this case it was a CTA, which is generally a commodity trading advisor, so they're generally technical focused, I could combine technicals on the market with my knowledge of options to try to structure trades that basically optimally perform given the technical or fundamental view of where the stock, or future in our case, was going. Working for a hedge fund was fun on its own right, but I prefer working with individuals. I've been teaching people how to trade since I really started in this industry. I was always teaching the junior traders. I was teaching at the hedge fund how to use options while they were teaching me how to do technicals, and decided I would rather be on the teaching side, the educational side. So I started Trade Academy in 2017. I joined Option Hotline as the chief option strategist in 2018 to provide this kind of content to people like yourselves. If you have to leave early, because I know some people get busy during the day, maybe something comes up, a work call, a kid, any of this stuff can happen. Do me a favor. Email me, keith@optionhotline.com. This is my personal cell phone number. So not a lot of people like to give out their phone numbers, but because I like the market so much and because I like working with people so much, I'm just going to give it to you now. Please do that. Call me, 312-600-8004, if you have questions that we do not address in the presentation today. And don't also forget to keep an eye out in your email, webinars@optionhotline.com. I'm going to send you the trade checklist that I actually use for structuring my options trades. So that's free. So I want you to make sure you get that. What we're actually going to discuss today is what are the current market trends, Which dip do I prefer to buy? Because not all dips are equal. Why I use options, that goes back to the core of why I started in this industry. In particular, why volatility matters and how I structure an option. And then the two ways that I buy the dip with options. So for those of you looking for shorter term trades or swing trades, that's one way I can buy the dip with options. For those of you looking for long term holds, I can create a trending portfolio buying the dip with options. And that's what I do. I mean, I've got two different strategies, mostly on the short term and the long term, and I utilize options for both of them, just in very different ways. So let's look at the market. This was from the close yesterday. The markets are obviously down a bit today and actually dropping as we speak. The tech sector in particular is starting to get weak. Right now I see the S&P 500 down about 1.36%, tech's down 2.2%, and small caps down 1.95%. So we're getting a little weaker here. But after the close yesterday, we were back above some of my key moving averages. Those that are not familiar with my charts, the five things I really want you to focus on here today are the moving averages. Purple is the 10-day moving average, green is the 20-day moving average, blue is the 50-day moving average, yellow is the 100-day moving average, and red is the 200-day moving average. The reason I highlight those is because moving averages tend to be a key input for trend traders. When the stock price is above the key moving averages, it tells you that that period holder is making money, because you take the average closing price over, say, 10 days for the 10-day moving average. If the stock price is above that, anybody that has been buying the close every day for the last 10 days is actually making money and feels pretty confident. That's why moving averages tend to be meaningful. Those guys that have been buying for the last 10 trading days, 2 weeks, if the stock market starts to fall below, they start to see a little bit of red on their ledger and they get a little nervous. If you get below the 20-day moving average, those guys that have been buying for the last month get a little nervous. 50-day moving average, we're over 2 months now, people start to get real nervous. So, back when the GameStop craziness happened, we started testing some potential major liquidation, but because of the way the market functions and the way that this was really built off of people just closing positions because of a short squeeze, there were some decent reasons to be confident that that was a decent dip to buy. This one, we're going to have to see how it goes. I'm not so sure yet. S&P 500 still looks okay, being above the 10-day moving average as of yesterday's close. Today, we're back below. When I go to tech, it's much worse. So you can see that in tech, we are below the 10-day moving average, the 20-day moving average, and yesterday, we tried to breach the 50-day moving average, which has held since the election. So we haven't been below the 50-day moving average in tech since the election. That is a big level. That could create some serious panic if we can get below and hold below. That creates concern for me. So this is something that I am very nervous about on this market. If it goes back below, say today, after trying to recover the 50-day moving average, I think there could be some major position liquidation. So tech is not a sector I'm necessarily looking to buy. Small caps have skyrocketed since not just the election, but also the announcement of the first COVID vaccine on November 9th. Small caps tend to have a lot of focus on sectors like oil, financials, even retail, all these sectors that had kind of gotten forgotten over the prior 4 years. Oil prices are up from 40 to 60. Financials are doing better with bond yields rising. Businesses can reopen. People like small caps right now. So this is the really strongest trend in the market. I mentioned the simple moving averages. I just want to put the words out here right now for those that didn't take the notes quick enough. Simple moving averages take the average closing price over a recent period. The 10, 20, 50, 100, and 200-day simple moving averages are common examples. They are generally meaningless at the high level. 10-day moving average makes sense. That's 2 trading weeks. 20-day moving average makes sense. That's basically a month of trade. 50-day moving average, it starts to get a little hairy. It's 2 months plus a week. 100-day moving average, it's, I guess, 4.5 months. The 200-day moving average is 9 months. I'd prefer traditionally to have said 2 weeks, a month, maybe 3 months, 6 months, and a year. But these were the ones that everybody looked at. And so these are the ones that I have to look at, because if computer programs and people look at the numbers and everybody's looking at the same numbers, those tend to be the numbers that work. Self-fulfilling prophecy. Okay. So we use that self-fulfilling prophecy to make our decisions here on a lot of this stuff. Trend traders like to be long above the key moving average and short or out below the key moving average. So I'm going to draw on a trend channel here overall, just to give you guys another perspective on this and why I can get nervous on tech and not maybe yet on S&Ps or small caps. A trend channel is basically, it shows you the momentum. So you can see it's up in the S&P 500. It's going smoothly. We tested below the trend channel a little bit right at that GameStop short crazy Reddit trade thing. We tried to test below it yesterday. It didn't really hold. And right now, if one were to look for a dip to buy, buying near the low of a trend channel and selling near the high isn't a bad strategy. You just basically take the money as it goes. Note that though the high end of the trend is always rising, so you don't even necessarily need to sell at the high. That's just for short-term profit taking. In tech, the trend is breaking, especially today. Now, if today we had recovered this trend channel, I would tell you that probably everything is rosy and everything looks good. But tech is falling again today, meaning that it's not holding the trend channel and it's starting to give me concern on the markets. So this is not a dip I want to buy in tech. In small caps, we see that massive slope, great return overall. It's been a really, really big winner for 3 months now plus. There's justification for profit taking when you get into an index in the range of, say, $170, and it's already up to 230-ish. So $60, which is about 40%, just about in a matter of 3 months. That's an insane return, especially in an index. So I can see the fundamental reason to be bearish or out of this market, but while this trend channel is holding, it's hard to fight it. You could have said that this trend channel looked like it wanted to break back in January at prices just under $200 in IWM, and now we're 230. So we've gotten 15% in 2 months, less than 2 months. I mean, that tells you the power of these trends. And at some time, you just got to go with the flow and let it work, but also practice risk management. That's why I incorporate options, is to practice risk management. So to reiterate, what am I looking for? Which dip do I prefer to buy? The one in S&P and IWM where we're in the trend channel? I say yes. Below the trend channel, like in the tech sector? Absolutely not. So I want to find where the momentum is going and stay with it. That's why right now, for me, buying into tech is a bit of a dangerous game. You're starting to test into that idea of catching a falling knife, which a lot of people will talk about. It really means what you're doing is you're seeing the drop and just saying, I know the value of tech. Well, nobody knows the value of tech, because at the end of the day, computer trading algorithms tend to push markets below value, and that's where you want to be getting long when everybody else is investing, because they're providing the floor. I can't provide the floor. I don't have enough capital. You need a lot more money than probably anybody in here has to provide a floor to the market. Now, we can help push everything back up by investing when everybody else is investing, but we can't stop a fall. So I'm nervous about tech. I'm less nervous about small caps and S&Ps, but I'm starting to get closer to being nervous because they're looking like they may not hold the trend channel. We're going to watch out for the next few days. But testing the low end of the trend channel, not a bad thing. It gives us a good entry point. Below the trend channel is a bad thing. It gives us a bad entry point. Before we go to the next thing, I just want to let you guys know. So for those that have to jump off early, I do an outlier watch list. This is exactly what I put on it. I put in names. It's all from, actually, this is all from the NASDAQ, but the trend trading candidates that we are invested in right now have an average 160 profit on open trades. These are longer term holds. Swing trading, our average is 204% profit on winning trades. If you're interested, go to optionhotline.com/outlier. It's actually a very cheap watch list. It's only $97 a quarter. I just want to get you guys out there on that in case you are interested already. Go to optionhotline.com/outlier to take a look. Now, let's talk options. A question about fallout from the bonds. I think fallout from the bonds falling is two things before I get into the options. Number one, it provides potential for real yield from portfolio reallocation, which could create some rotation, i.e., if I can get a real yield from fixed income, I want to allocate a little bit more of my portfolio to that safety net. At the same time, increasing yields tends to be positive for the financial sector, which can be positive for small caps. So we may not necessarily immediately see the small caps continue higher with bond yields rising, but remember a couple years ago when bond yields started to rise, that created a market liquidation event because everybody thought that if the long-term interest rate was over 3%, I believe it was, that would create a major trigger for portfolio reallocation. And because everybody thought 3% was the number, 3% became the number, everybody did it, crash, and then you rally out of it. So I don't necessarily want to be long during the crash, but I love finding opportunities to buy after the crash. All right, so options do have an incremental risk over stock that have to be pointed out here, and I always just try to make sure that everybody understands this, because for those of you that have been trading or are thinking about trading, risk management is, I think, the primary skill that has to be understood. So we all like leverage, we all look forward to leverage, but risk management is the thing that keeps us solvent every day. So markets can trade irrationally for longer than most people can stay solvent, but if you practice good risk management, then you can outlast those irrational days and stay solvent and stay in the game. Part of that risk management is understanding that transaction costs exist as well as assignment risks, as well as options decay and options volatility. So transaction costs are higher in options, partially because they're riskier. So they try to create a little bit of a barrier to entry into options. Brokerage firms have also gotten to the point where stock is effectively free to trade. There's just other ways that they make their money off of it as opposed to charging a commission to the customer. Assignment risk, if you're trading short options, is a big risk. I don't use outright short options in most of my programs because they create potential risk for margin, where you could lose 100% of your account or even more and owe your brokerage firm money. That's not a good situation to be in. We don't want to take that risk. I'd rather have defined risk, know exactly how much I could lose, even in the worst case scenario where stock goes all the way to zero because it turns out they had accounting problems. Options do decay in value over time, so if I'm buying options, they become worth a little less every day. Think of it like an insurance contract. If I'm betting on myself getting injured in the next year, well, every day that passes that I don't get injured, I would pay less for that, because if it's just for calendar year 2021 and it's December 30th, I have one day to get injured to cash in on this insurance contract, versus if it's on January 1st, I have a feeling I might get injured this year. Who knows? I'm a little bit accident prone at times. Of course, volatility is the other one. Implied volatility rises and falls every day. This is what market makers in the options market are trading off of. This is what proprietary traders in the options market tend to be trading on, is the rise and fall of volatility, best illustrated by the VIX. And that can create major profit and loss movement, and we'll talk a little bit more about that volatility in a few slides. So for those of you familiar with options, this may feel a little like a recap, but it may also provide a different perspective on how I view options and how I like to think of them. Okay, so I still urge everybody to look to kind of follow along here and think about how options work for you. This is going to be a simple exercise on stock versus options. If I have a stock that's trading $100 and I have a $10,000 account and I'm putting it all into the stock, I can buy 100 shares. Now, if I think this stock is going to rise 20% over the next month, that's a pretty darn good return. And I can make $2,000 on my $10,000 investment. That's good. My targeted max loss, maybe I say that if the stock goes below $90, it proves me wrong. I don't want to lose more than $1,000. So if it goes to 90, I just get out and I start again. Stop losses are risk management. This is what keeps us solvent, as we talked about before. But at the same point, if I go to sleep tonight and then I wake up and my theoretical stock here turns out to have been a sham, and now it's trading $20 a share or $30 a share, you get it all the time with like biotechs. They have an FDA announcement. Turns out, this is not a sham situation. It just turns out the FDA rejects their drug. The stock can cut in half or more overnight. I don't want to take that risk in stock because I think I have an exit and then the market doesn't provide it to me. Because if the stock tomorrow morning is trading $20, I can't get out at 90. I'm probably never going to get out at 90. I have to take an 80% loss, an $8,000 loss, and that sucks. But if I can trade an option, for example, a call option, for $5 per contract to give me the right but not the obligation to buy the stock for $100. Now, this creates a different risk-reward scenario. Now, because I'm paying $5 of premium, I need the stock to rally to $105 to break even instead of just not moving. Okay? Now, if I buy 2 of these calls, I now represent 200 shares in the market instead of 100. And if I buy 2 of these calls, I spent a total of $1,000. I didn't spend $10,000. I have $9,000 of cash in my portfolio. What I want to do with that is up to me, how I want to manage my portfolio, whether I want to stay in cash with it or allocate it to other trades. But right now, if I buy 2 of these calls, I've spent $1,000. My max loss is $1,000, whether the stock goes to 90 or 20 or 0. The problem is if the stock doesn't move at all for the next month and just sits at $100, I still lose $1,000. The good thing is, if I was right about my thesis and the stock goes to $120, my profit's now $3,000 instead of $2,000. And if the stock goes even higher, you can start to see those exponential return parameters. So it's much, much more profitable on the way upside, much, much less damaging on the downside, way downside, and somewhere in between, in this little triangle, stock was better. So between $90 and $110, I would have rather been in stock. Above, the option's better. Below, the option's better. You start to see the trade-off. Options give us leverage and defined risk in exchange for that option decay, which you're capturing right here. So if the stock rallies from $100 to $102, I'm still going to end up exercising my option or selling it out for $2, but I lost money. So even though the stock was up 2%, I didn't do so hot. But if the stock is up 20% like I was theorizing it could, I did 50% better than a stock position. That's pretty good. So it's all about the confidence in the thesis, understanding the technicals, and understanding how I can pair these options with technicals. Because if I start theorizing that this option, the stock is going to go up 3 to 5% next month, I don't need options for it. It's not going to give me the leverage. Defined risk means nothing. If I'm not even getting leverage on top of it, I'm walking away. This is why volatility matters. That call option priced at $5 may be too high, too low, or somewhere fair. So let's assume that my options analysis tells me that $5 is the fair value of that $100 call. And then I look at the marketplace and they're saying, well, you can buy it today for $4.20 because implied volatility, that volatility level, the parameter that we're putting into the model that says that we think the stock's going to move less, or other people say the stock's going to move less, means that these calls are priced at $4.20. Now I'm getting a 17% discount on my value. This is where I get sale. I'm buying an option on sale, I get more leverage. When I see an option on sale, I don't want to buy the at the money call, I want to buy leveraged calls. If I have a combined knowledge of where I think this stock is going with a reasonable percent probability, plus I get low implied volatility, I can buy options on sale for $106 call, which means the stock has to go all the way to $107.97 for me to break even. But once it gets above that, I get huge leverage because I'm buying these calls for a 28% sale from fair value. And if we had expensive options, which I don't want to buy, it's about a 60% discount from that. This is what I want to find. I want to find cheap options when I'm swing trading. The VIX right now is fair to cheap in spite of the fact that the market's falling a little bit. This means I like at the money or out of the money options. And you can see a visual representation of why. Here is those cheap options. Here are the expensive options. We'll just zoom in rather than trying to focus on it here. When you see cheap options, out of the money calls tend to give you all that leverage. We talked about the upside from the $100 call in red here. So that was a $3,000 payoff if I hit my target of a 20% move. If I could get the $106 calls and spend the same amount of cash, now I'm not buying 2, I'm buying 5. So when we get up to $120, I'm not making $3,000, I'm making $6,000. You see that big return from leverage. Options are all about leverage and defined risk and finding when they are priced wrong. So for me, I like buying out of the money options when volatility is too cheap. When volatility is too expensive or even too cheap, an in the money call option acts a lot like stock. This is why a lot of people will promote always just buying in the money calls. Why? It acts like stock. They don't have to have as much of a cushion on their volatility risk that they are looking for. So even if implied volatility is cheap, it acts a lot like stock, just a little bit better. Now, when implied volatility is expensive, it acts a lot like stock, just a little bit worse. But when implied volatility is expensive, you get much more risk out of those out-of-the-money options. So you can see there's this huge payoff potential for out-of-the-money options when implied volatility is low, or even at-the-money options when implied volatility is low. But when implied volatility gets high, there's really no reason to do anything other than buy stock or in the money calls and just do a stock replacement strategy, because you're not getting that leverage to the upside. This is what I try to avoid. So when implied volatility is high, I'm not buying out of the money options. When implied volatility is low, that's exactly what I'm looking to buy. There's a question, what deltas do I look to buy? You are one slide too early. When I'm trading a trending market, so just trying to take a longer term view, I find a long entry that's in that bottom portion of the trend channel. So not below it like we are in tech, but in it still, like we maybe see in small caps or S&Ps. I'm a little more confident on S&Ps just because we haven't had that magnitude of move in small cap that we had in small caps. And I structure my trade with 3 to 5 months to expiration, 65 to 80 delta options. This is effectively a stock replacement strategy. There will be some implied volatility risk, but not as much. Why is there not as much? Because we have more what's called intrinsic value. It's how far the option's in the money. So that $94 call with a stock trading $100, it's $6 in the money. It means that even if the stock doesn't move, it's worth $6. The $100 call, stock doesn't move, it's worth $0. The $106 call, if stock's up $3, it's still worth $0. So the intrinsic value helps in a trending market. Why? Because we're not looking for that explosive move of 20%. I'm basically doing a stock replacement strategy so I can leverage my portfolio by allocating capital to other trades still. Instead of putting all of my money into the one trade for $10,000, I've got my defined risk to the downside just in case, and I can go look for a couple of other trades. I'll probably still keep some cash on the sidelines just in case. We don't want to be always 100% invested long in the market. But if I can put a little bit here, a little bit there, find 4, 5, 6, 7 trades, and have some cash on the sidelines, I've now got a leveraged portfolio to the upside with defined risk, even though I'm trading stock replacement strategies. It gives me that momentum for the trend, taking that percentage return we're normally getting in the trend, and I can kind of predict how much percent we're going to get in the next 3 to 5 months if I just follow the midpoint of that trend channel. So that's how I try to analyze whether it's a good investment or not. Because if we're going to stay in the midpoint of that trend channel for 4 months, well, now I can predict where we're going. And now I can know whether or not the options are priced appropriately. Now, for swing trades, it's a little different story. I'm looking for a shorter term move, maybe back to the upper section of the trend. If I'm not just predicting the direction, but also where the stock will find new resistance and could stall, such as a recent high, I can pinpoint my trade. So if I'm worried that we're not going to actually continue the trend, but we're actually going to recover from the current dip and then stop at the highs for a little bit to consolidate and figure out the next move, this is a great time for swing trades. So that's where I switch my concept and say, okay, I want to focus on short-term trading by taking advantage of shorter-term options. So I want my stock price to go through or away from my long strike and stop at my short strike. That's the goal of any debit spread. So a debit spread is where you take a simultaneous long position in one strike of call and a short position in a higher strike call with the same expiration date. There are other strategies that are more complicated. Happy to talk about them offline. If people want to email me or call me, we can talk about them further. But today I'm going to focus on just a simple debit spread. The idea is here, if I think that Qs are going to go back to their previous high, then I don't want to buy that far out of the money call. So the previous high was on February 16th. The high made was $338.19. I don't need to buy like a 330 or 335 call because we're just not going to make any money on that. So if the prior high is 338, maybe I want to sell a $338 or $340 call saying it's not going to go through that. So that's where you get this structure. Let's pretend in my $100 stock that the previous high was $106. Well, then if I think we're going to stall there, the $106 call has very little value to me, even though technically for the options market maker and everybody else, it has some value because there's a potential for it to spike through. For me, if my thesis is that we're going to go from a current price of, say, $98 all the way up to 106 and then stop, well, I think there's more money to be made buying a call spread, the debit spread here, than buying the outright call. Let's do our comparison as always. So if I'm buying the call, I don't make money until we're above $105, because remember, this was a $5 call. So if I think we're going to 106 and that's the ultimate upside, all I'm saying is that I'm risking $5 to make $1. It's a bad trade because I'm risking 100% to make 20%. So unless I'm really, really good at my prediction on probability, this is probably not going to be good. If I was going to get out anyway, once we get to $106, I don't have that unlimited upside, because if we go to 107, but I sold once we hit 106, my unlimited upside is gone. There is nothing there. So why would I swing trade expecting a move to 106, planning to get out at 106 by buying the $100 call? It's not a good trade. Worse would be buying the $106 call. Better would be buying the call spread, buying the $100 call and selling the $106 call, doing it in an equal dollar amount, risking my $1,000. Now, my break even was $102.30, because that's what I was saying that the debit would be for that call spread. And if we get to $106 as planned and stop there, it's worth $6. So now I'm risking $2.30 to make $3.70. That's a much better trade than risking $5 to make $1. I have a greater than 100% return instead of a 20% return. So even if I'm wrong 50% of the time, I'm making money in the call spread. If I'm wrong 50% of the time, I'm losing money in my call trades. This is why call spreads can be crucial when we're buying a dip as a swing trade. 1 month move, 6%, great return. But you got to be right a heck of a lot more often than wrong, buying it out and in the money or at the money call in this scenario. And that's just not all that feasible. So if I can create a scenario where the odds are in my favor, that's better. So here's a recap of the general trade idea. And again, this is the delta question that TJ had. I'm looking for a setup with a stock that's in an uptrend that's falling lightly. Now, if it's the Qs, we're out of that trend channel. We're below it right now. So what I want to wait for is a recovery of the lower part of the trend channel for me to get in. Even S&Ps and small caps today look like they may fall through that trend channel. So I'm not doing the swing trade today. I'm waiting for us to get back to the lower part, much like I'm doing in a trend trading system. But if I'm thinking that the trend will stall, a swing trade makes more sense to me. If I think the trend will continue, a trend trade makes more sense to me. It's all about the term and the leverage I can get. So with about a month to expiration options, I can buy a long call that's roughly at the money, maybe slightly out of the money, and I sell a call further away above that resistance point, like above the previous high. So if it was the Qs, where the previous high, as I said, was, what was it, 338, I might be selling a $340 call. That way, we don't quite get to my short strike. That's not a bad thing. Going through the short strike isn't perfect, so going just shy of it is absolutely perfect. Going right at it is the 100%, the holy grail. But if we can get close to it, that's really good to me. So, if I was structuring today in the Qs, I might be buying a $317 or $320 call, something in that range, and selling a $340 call. It's just that simple. Creates leverage and allows me to play for the bounce back in the markets without risking everything. Now, again, I'm not looking to buy that today because we're not back in the trend channel, but that's how I would be doing it if this were the price of the lower end of the trend channel. So now what I want to do is take a little time for Q&A. I think we have about 10 minutes, and I know some questions always pop up as we talk about this sort of stuff. And I want to know how I can work for you. So if you have questions, and you want help planting the seeds to becoming a winning trader, the first thing that I can do for you, and this is the cheapest entry point we've really got, this is the Outlier watch list. It's weekly. So every week I send out my swing trading ideas that are on my short list, like 5 ideas that I'm looking at to swing trade with the price trigger, with a general sense of the call or put structure. I also send you a list of the names in the NASDAQ 100 that I am looking at to enter as a trend trade. These are long-term holding positions. They have really good potential, and obviously you can see the average profit on these open trades, these are options profits, are 160%. One of our trend trading portfolios last year, I think, was up 145% for the year. These are good numbers, I think. So I'd like to talk to you guys more about these. If you start here, you have questions, obviously always free to email me, keith@optionhotline.com, or call me. Now with that, let's go through a couple of the questions here as they're popping up. Is the tech market going to crater? I don't know, but right now it doesn't look good. So for me, seeing this tech market starting to fall and getting below some of these key moving averages and below the trend channel creates some real concern. So I'm very nervous about tech and the potential that tech could drag down the rest of the market. But if I start seeing tech start to find some support, particularly semiconductors, then I can get a little more confident actually in investing in small caps and S&Ps. So as weird as it seems, I'm waiting for tech and semiconductors to stop falling to invest in the other sectors. Because at some point, the tech sector is going to drag everything down since it's been that leader for so long. Day trading options. So with the programs that I'm doing here, I don't focus on day trading. They're shorter term holding periods in the swing trades. They can be as little as like 2 or 3 days. Part of the reason I don't like to day trade the options is because I send out ideas, of what I'm looking at for a swing trade. And if you're not glued to your screen, it may show up an hour late for you. Now, getting an idea an hour late could be the difference between a winner and a loser, or I might already be out of the position, and it's hard for a lot of people to spend that much time glued to the screens. Those that are interested in day trading, I do provide mentoring services to talk about how I have day trade. I mean, I used to, as a market maker, I was trading 20 or 30,000 contracts a day. So just to give you some scale on it. So that was definitely a focus of mine prior to my time at the hedge fund, and now is the educational stuff, but I do tend to move away from that in terms of trading programs. Am I the only coach at Option Hotline? No, we have a number of mentors tied in. If you go to optionhotline.com, you can see a list of who we've got that are providing content under the, I believe it's authors tab. So we've got a number of people tied in that I'm sure you're all familiar with. And if my style of trading doesn't necessarily fit what you're looking for, I'm sure we've got somebody that can fit your style of trading. So again, optionhotline.com/outlier is where you get that Outlier watch list. Again, it's only $97 for a quarter, so it's about $1 a day. Skip a few Starbucks runs and it pays for itself already. I've had a number of people that have been telling me the last week or so, because I had a bunch of put trades that we were looking at over the weekend, that it's already paid for itself many times over. So, for those of you looking for just sort of an entry point there, feel free to do that. We do have other programs, the actual trend trading program and the swing trading program, that are also available for annual or monthly subscriptions. So take a look at those under my name. Now, is the phone the best way to reach me during market hours? For me, email is usually the best, but I'm happy to answer a call during market hours. I will do my best to take the call. Sometimes I'm already on a call, so if you miss me by phone, throw me an email and then I can call you back. We can schedule a time to have a call. A lot of people don't like to make themselves available like that, but I'm happy to do so. Do I take other spreads? Absolutely. Lots of different spread trade options as you go through trades. So calendars, diagonals, all of these things have a role in a portfolio. For me, I tend to avoid credit spreads just because I think people tend to over leverage them. And I just personally, I just don't like getting into that over oversized credit spread to try to squeak out some, nickels in front of a steamroller. So, selling a put spread right now in the Qs just wouldn't necessarily fit for me because your risk reward profile, you're potentially risking $5 to make one. And now you can structure that call trade, like I said, where you're risking $5 to make one, but I can structure a call spread trade where it's got a greater reward than the risk. Condors, I like Condors, but I don't have any programs or anything that I do right now with Condors. I've been focusing on call spreads, and call diagonals, and put spreads and put diagonals as well. But for our trend trading portfolio, I think for those of you that were on the previous presentation, he talked about long only. For our trend trading portfolio, we focus long only because of the fact that money flow does still tend to go into the market. 401k investments, everything else, money has to go somewhere. For swing trades, right now I only have short positions because of what I'm seeing in the tech market. I'm probably going to keep it that way for a little longer. And for our trend trading portfolio, I just lightened up a lot of our long positions and went heavily into cash to define our risk that much more. It looks like that may be the extent of the questions for the moment. Are there any other questions before we maybe take a short break before the next presentation? Well, if anything pops into your mind and you want to talk more, you got my contact information right there. Keith@optionhotline.com, the phone number. I do urge you to check out the Outlier watch list. It's a cheap entry point into getting some really interesting trade ideas real quick. And then if you have questions about those ideas as you're looking at them, you can always reach out to me because I try to make myself as available as possible. Last thing I want to see you guys do is trading with a lack of information. Thanks again to all, and I hope you all have a great rest of your trading week. Keep an eye on that tech market because it's looking a little bit scary again today.